And we're live. I can see out of the corner of my eye myself on a television screen which says that you're tuning in to this live on YouTube for the Smart Property Investment SPI weekly debrief. We get together. It's a relatively new initiative to sort of break down what's taken place over the last 7 days as we enter the weekend and get set for all the trials and tribulations of looking at property and getting out there doing open homes. So opportunity for us to pull apart what's taken place across the world of property, finance, economics, geopolitics, whatever it is, all those different factors which are shaping property markets and maybe your strategic positioning as you continue to create wealth through property. So it's going to be raw, it's going to be uncut. I'm probably going to be a bit opinionated whether you like that or not. I don't really care. That's why you're tuning in. Most of the time I get it right, and I do get it wrong sometimes, and I'm having to put my hands up when I do get it wrong. But someone that gets it wrong more than me is my co-host, Liam Garman, managing editor of real estate at Momentum Media. Hey, Garn.
Wrong all the time.
You like it? You know, more than me.
If there was a betting market, just do the opposite of what I say.
Yeah, okay.
You'd probably be making a lot of money. But
to be fair, you are an actual real professional journalist, whereas I'm a hack sort of CEO of a property technology company managed. So, they're coming together two great minds.
It and I write it.
Yeah.
That's what I do. But, I mean, it's been a pretty big week. It's been a very big week, and you touched on geopolitics before. And in the world of journalism, there's a meme online, which is whenever anything big happens, there's a big story, COVID and what it means for Australian property prices. And that's a big meme online because something happens in the world and some journalist is always going to sit down and say so-and-so and what it means for Australian property prices. And I had to steady my hand before writing a story of the war in Iran and what it means for Australian property prices.
Well, let's talk about that, though. We should do.
We have to.
There will be consequence. There will be consequence.
Without a doubt. I mean, there's, we did a podcast with one of our colleagues, Steve Cooper, a few weeks ago, and it's quite prophetic in the sense because we were talking about Australia's fuel supplies and in the risk of a geopolitical problem, and you only have 28 days of fuel. Now, in a real problem, a lot of that fuel is going to be used by emergency services, not mums and dads driving to work, and not trucks delivering food to stores. So what you're going to see is prices are going to go up. Inflation's going to go up, and the Reserve Bank governor has already highlighted that, well, this is going to blow out any hope of getting inflation back to that 2 to 3% target band. So, it's undeniable that this is going to have some very unforeseen consequences in the Australian economy.
So, for a simple bloke like me, and I get called simple
Never
quite regularly, maybe complicated. It's probably
we'll go
complex.
A complicated
maybe more
person.
complex.
Yeah.
Not difficult, though.
You're not difficult. You're complex. Yeah.
Complex. Really simply, war in Iran. We don't know how long that's going to take place. Iran is probably looking for a long war.
Oh, yeah.
Which would be disruptive to the region. America and Israel and the associated allies are looking for a short war. I think he sort of said, sort of 4 weeks or so. But irrespective of all of that, it's going to lead to inflation, and inflation will lead to potential changes to the RBA's official interest rate. And as that goes up, that means mortgage is going to go up, and therefore the consequences of that is you'll have cash flow constraints and considerations to think about as a property investor. Simple.
That's simple. But I mean, it's something that you and I.
But goods and materials are going to go up, to your point as well, because the fuel's going to go up. Blah 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 blah.
And it's quite ironic because this is where you have that real inflationary spiral in so much as costs of goods and materials will increase. So, what does it mean for property? Now, okay, maybe a bit silly that we tie everything back to property, but our listeners are investors. And also, as you and I have highlighted, property revenue is the second biggest revenue driver for the government. There is a reason that state governments are able to go on these multi-billion-dollar infrastructure splurges, and that's because they're really cashed up from stamp duty. So if that starts tapering back, well, actually the Australian economy will be tapering back as well. But we did highlight before costs of goods and construction increasing. We're already at record high levels of insolvency for building and construction companies, which is one of the reasons why it's just too expensive to build new homes. We've got more population coming in. Homes are too expensive to build. Businesses that are in the construction industry are becoming insolvent. If you do have the interest rate increase further, you will see more insolvencies as well. We're not actually going to be able to build new homes to house our population. So what does it mean? Yeah, there'll be a lot of mortgage stress out there. There'll be a lot of businesses that are doing really tough, a lot of redundancies as well. But that doesn't necessarily mean that this asset class is going to go back, because it's a supply and demand issue at the end of the day, and there's not going to be any new supply.
Yeah, and this, all of this is sort of happening outside of the bubble of your control, right? All this is largely irrelevant, and we'll get into it in a moment in relation to discussion around capital gains tax changes and changes in negative gearing. Like, all of this is a distraction for property investors, and I would say all of this is a distraction for the Australian government when it comes to housing. The issue with housing is supply, and supply needs to be, first and foremost the major focus that they're working on. I don't think the government's probably too happy that what's taken place in Iran is going to really complicate a lot of the issues they have in keeping inflation under control as it is. It's already going in the wrong direction. Now, whether or not this will give them the excuse to say, well, we can't really help it because ... the Strait of Hormuz is closed. I think Iran provides, a huge amount of 40% of the oil, but mainly through to China and stuff like that. So you're going to see all of these things manifesting into higher prices at the pump, higher prices at the grocery stores, potentially higher prices on your mortgages. So that's what this means. This is geopolitics and how macro aspects of geopolitics manifest into the incremental changes to people as a result of it. And they're talking about potentially fuel constraints that we haven't seen since 50 years ago, in most people's lifetime. So, imagine rocking up at the petrol pump and they say, we don't have no petrol.
Yeah.
Imagine what that's going to do to things.
Your way of life as you know it, the civilization that you've known has ceased to exist. To your point earlier, I think it is almost a bit of a godsend for the government, right? Because now they have something to blame. The CPI data that came out only about 2 or 3 weeks ago now painted a really bad picture, a really, really bad picture. The trimmed inflation mean went up. So everything that we've done to date, it's still getting worse. Now, that hasn't factored in the most recent interest rate hike, mind you. But, would that be deflationary? Probably not, because you have such demand-side stimulus coming in. The 5% deposit scheme, now all of our listeners know you and I love bashing what is reasonably a very bad policy, and I'm just going to go out and say it. But that was inflationary. So it's going to kind of balance out the deflationary effects of an interest rate hike. Funnily, though, with the CPI figures that came out a few weeks ago, what actually dragged CPI down was the cost of petrol. Because, when you go to the pump and you're paying, $1.80, go back to a few years ago when you were paying $2.20 anyway. It's actually gone down. Yeah. So that actually brought down the mean. It was government spending. It was housing. Electricity went up by 32% over the year because you had the rebates taken off. Yeah. So that dragged it down, and now it's going to anchor it higher. It's going to be, yes, it will be used as a scapegoat for the government because, mate, it was already heading in a pretty disastrous direction.
It was, and sort of back to Phil's armchair economics, right? The economics of idiocy.
Well, it's not idiocy because you're on the same side as basically everyone else.
I'm just a bloke trying to get ahead, right? Yeah. But it's clear that the government is spending more money than what it's able to manufacture. So therefore, it's scrambling at the moment. It knows there's hit a spot of bother, and Australians are starting to wake up to it. So they're scrambling to try and fill their coffers. So rather than looking at the expense side of the equation, anyone that's in business should be able to understand this. Anyone doing year 10 business studies can understand this, right? You want to balance your books. And the idea of being in business, I would say also of being in government, is to actually have a positive situation on your P&L rather than a negative situation every single year. The government is completely opposite right now. They're spending way more than they're making. So rather than looking at trying to maybe tinker with the spending bit, they're going, let's just try and make more money to try and compensate for that. That's what they're doing right now, which is really, really base and very, very basic. And it's just going to put Australia into more debt moving forward. I think there's structural deficits on our budget for the next 10 years of forecast, right? And I sit there and just go, well, you guys are in charge of running the shop. That means you're borrowing in order to sustain the Australian economy. And that will, the main consequence of that will be future generations going to have to deal with it. So, hot tip, there will be a changing government. I can guarantee it. When it takes place, I don't know. And I think we're going to be in a position of making sure that not too much damage is done before we actually get some good economic operators in there, because it's flawed at the moment. However, the job of government largely is to stay in government if you speak to them, and they'll do whatever they can in order to carry the votes in order to sustain themselves. So this is the environment we're in right now. So property investors, and the property investment economy is firmly in their sights as a way in which to generate more revenue. Now, I've seen Ben Kingsley, who's the chair of PICA, the Property Investment Council Australia. He's done some very good work recently, helping to educate Australians about how water works, but more so helping to educate the government how it works, because I think there's a lot of boffins down there, and I'm not criticising the public service. Look, if people choose that as a career and profession, brilliant. There's some great people down there doing some great work. But I think a lot of the times they get caught up in the bubble or the lens at which they look through things, and sometimes they look through it the wrong way. If you like a telescope, right? If you want to use that sort of stuff, so go and check out the stuff that Ben Kingsley's done, and just look up PICA, Property Investment Council of Australia. Go and check it out. And he's really done a good job to educate people about how it all works. Around negative gearing specifically, what he's trying to, and it's common sense stuff, and anyone knows this, right? He's pretty much saying negative gearing is not a strategy, it's a moment in time. So when you buy an investment property, it's going to be negatively geared for a period of time. And during that period of time, there'll be some tax concessions connected with it, because you're in the business of providing rental accommodation and your business expenses are more expensive than the revenue it's generating. Therefore, you've got a negative item on your P&L, right? It's for a moment in time. Properties turn positively geared. And for people who have a buy and hold strategy, positively geared properties generate positive income. Positive income is taxable, and the government actually get benefits from those taxations. So when you pull it all apart, Australia is better having property investors in there. Yes, there's a period of time when there is some tax upside for them, but eventually they start paying tax, and that is really important. And go and have a look at the numbers, right? You know, in the balance of things, Australia is better off with property investors because they provide more money to the tax regime than taking away from it. You never hear about this, right? It's an easy target, and that's where it is right now. So I'm hoping that sensibility prevails in any discussions around changing the tax regime. Capital gains tax, Ben will be, and you can go and check out his the PICA's proposals around it. I think it's a sliding scale, the idea being long-term rental accommodation. You want to be providing people housing, a third of Australians rent, so someone needs to be providing rental accommodation. And the construct of the Australian economy and the way in which housing works in Australia is that private landlords retain and provide the majority of housing stock. So capital gains tax, their suggestion is, I think they're pretty much saying there's going to be a change, but their suggestion is largely, hey, why doesn't it be a sliding scale? If you hold a property for 5 years, therefore you get the 50% discount on the capital gains thing. So that's their solution. But whether or not you're going to have anyone in Canberra listening to the people who actually know what they're talking about, I very much doubt it. They would have created a think group with a whole bunch of disparate agenda lobby groups who will put a position in place which will probably shape their decisioning around it, and the outcome you get will probably be the wrong outcome. I think our producer Jacob has something for us. What do you got, mate?
I've got a question from a viewer asking if you would expect any time in the future for the Australian housing market to see a similar downfall like New Zealand and Canada.
Okay, so the question is, if you didn't hear that, whether or not the Australian housing market will see a downfall similar to New Zealand and Canada. So in New Zealand, and probably someone can speak better than this, they changed the negative gearing regime, and that's really slowed down the market for a period of time. It's being reset now. Back to the supply and demand equation, and if you want to wrap that up also with migration, simply put, we're just not building enough houses to sustain the population we have today and or the population for the future. So there's always going to be pressure on housing until that's remedied and it's ameliorated. So until we get the balance right, there's going to be pressure on housing. So that significantly will be a huge driver for sustaining property prices. And the Australian government is not going to want to see housing prices go back. Now, this is the thing around affordability, Liam. Everyone wants to enter the market at a point in time. And if you say to young Aussies, first-time buyers trying to get into the market, we'll make it cheaper for you to get into the market by all these things. But once you're in the market, are you happy for your property to go down 10 or 20% because of changes to government policy? Every single one of them will say no. Then look, once you're in the market, you don't want housing to go backwards. So the government will be doing everything they can. Our superannuation, as our superannuation funds and our banks are intrinsically connected to the inherent value of Australian property prices, and they're not going to want to see negativity in that market because you mess with those economics. Banks will start delivering different profits. They'll start potentially being in a position where a lot of Australians are in negative equity and they have to foreclose on people. That's not good for anyone. So no, I don't see it happening. But it's mainly as a supply issue.
And look, I can't speak to the Canadian New Zealand example. I have seen the graphs where they're going down. I was speaking to an agent out in Perth where the average days on market for some areas is like 8 days.
Yeah.
You have an open to inspect on the Saturday, it's gone by next Saturday. And the anecdotal evidence on the ground is that obviously there is a very big investor-led drive.
Yeah.
Still huge liquidity in the PPR owner-occupier market. Yeah. Like there are multiple ways of looking at this, and you could say Sydney. Okay, Sydney is very unique where there is pretty substantial affordability constraints. When you go to some of the smaller cities and regional areas, well, it's not really an affordability issue because when you look at the demand side stimulus that you do have, whether it's the 5% deposit scheme or the first home buyer grant, where you get basically free money, stamp duty concessions for first home buyers, all these different things. Well, there actually are a lot of cities where home ownership is very affordable, and it leads to the culture of Australia, which is culturally we're property obsessed. Yeah. When you have that, when you're quote unquote have an affordability issue, but your days on market are still single digits driven by extreme PPR demand, I don't see it going south.
Yeah. Okay. We've got another question, I believe, but hang on one sec. I don't want to steal Ben's thunder. He's done Ben Kingsley at Property Investment Council Australia. So just around at the capital gains tax changes, changing negative gearing. Go and watch those videos. Just look up Property Investment Council Australia on YouTube. They're quite long. They're sort of 30, 40 minutes. Great for your education as a property investor, but he goes into great depth and detail, provides a lot of data to give evidence to a lot of the positioning that they're coming up with. And I would like to think that every single politician in Australia, all they need to do is probably spend an hour and a half to watch those two videos that will really help them understand property economics a lot better and hopefully make more informed decisions. So I encourage you to go and watch that. Once that's been out, we'll break it down a little bit more over coming times. I really want to get to help everyone actually understand the economics of the tax regime in Australia. It's positive because of property investors. So the idea is that, and the government will give you this idea, is that they want to rebalance the playing field. They want to make it more equitable. This idea that property investors are all taking and getting taxation benefits from it. In the balance of things, they provide more than what they take financially to the bottom line. But importantly, they are the providers of rental accommodation for people to raise their families and have safety and security in Australia. Don't mess with it. Jacob, what do you got?
So the question is, at a world stage, Australia's property market is quite unique.
Yep.
The way that Australians treat property more like assets than they do as a place to live.
Yep.
How does that not feel like a bubble ready to burst?
It's a fair question, and it's a question that's been asked for years and years. So this is the idea of Australia is unique, and it doesn't really align with the norms that you see in property markets in other parts of the world. And you look at, the World Monetary Fund or the IMF or any of these sort of global bodies will tell you, based on their indexing, that Australia is out of kilter to the rest of the world. And this idea, the idea, which has been hijacked a little bit, that Australians see property as an asset. Certainly aspects of the Australian population see property as an asset and a vehicle for wealth creation, but largely it's still an aspirational strategy for most Australians to try and enter the market to give safety and stability to their housing and all that sort of stuff. In America, they've configured their investment regime that that equities, so stuff listed on the stock exchange, is where most people play to manufacture and create wealth. That's how it's geared in Australia. In America. In Australia, it's geared a lot more towards property investment. And the reason why is because the Australian government many years ago said, we're not really good landlords ourselves. We've tried to create and be the providers of rental accommodation in Australia. It didn't work. So therefore they said, we'll allow that to be the bastion of private landlords. So they created this environment. Property investors did it. Because if Australian mum and dad investors weren't the owners of the rental stock, that means the government would need to be that, and I wouldn't give them the opportunity to do that right now because they can't get it right at the moment with what they're in control of, let alone trying to be the landlords of every Australian for the third of Australians that rent. So that's just the way it's constructed here in Australia, and you can either sit there and complain about it and say it's not right and it's out of kilter and therefore there's going to be a bubble and the bubble's going to burst, that's fine. Or you can actually be a participant in it, and therefore that's the reason why podcasts like the Smart Property Investment Show and what we do here is so popular, because you have a lot of participants.
I think if it was a bubble, now there's a lot of people that are investing. They see it as a shortcut to wealth, and that might be a bit of a hallmark for a bubble. Like when everyone buys Bitcoin because Paul next door made 20K from it, and you want to get rich quick scheme. Yeah, that's a bit of a hallmark of a bubble, but 60% of lending still for owner-occupiers.
Yep.
Now, so a big portion of really what's being bought and sold are for people that need a roof over their heads. That's not going to go anywhere. You're always going to need a roof over your head. You might not be trading your Bitcoin tomorrow if it ceased to exist, or if quantum computing pulls it apart and ledgers are useless. That's a very intangible thing. This is tangible. 60% of loans are still for PPOR. And that doesn't include people that, say, rent vest. If you're in Sydney and you look at the maths, it's like, well, it's better for me to put my money in another city or in a regional area just as a store of value, or I would like to move to Brisbane or the Sunshine Coast in a decade and I'm going to buy it now and slowly pay it off. That doesn't include rent vesters. So I think it's very fair to say that 70, 80% of loans realistically are people that are doing it for their primary place of residence or a future primary place of residence or that single store of value. So really that speculative investing that people are pointing the finger at, which is the hallmark of a bubble, I think it's overstated, and the data's not saying that investors are just piling into the market for the sake of it.
There might be outliers to that, and
there are outliers.
There's bubbles getting created in
but
certain...
it's not like, what was it, tulip mania in the 1600s where everyone was just buying tulip bulbs for the sake of it. This is, you can't really compare it.
No, and if you go back to, and go and watch Ben Kingsley's videos, there is less property. It's actually heading down. So you see... from about 2000 or so, the rate of property investors increased quite a lot, and then it's flatlined for about the last. These are the number of Australians who are investing in property. Yeah. It flatlined for a number of years. It's actually dipping down at the moment, and a lot of that is going to be a consequence of, number one, the fact that the government sees property investors as a carte blanche opportunity to tax as much as possible to remedy really poor budgeting decision making. So they're an easy target. Let's go and get more out of them. At a state government level, and Ben uses the example of Victoria in this, just how stuffed the market is down there as a result of government decisioning, particularly around property investment. They introduced those new legislation, I think it was last year, 100 and something new things that to govern property investing. Some of them are okay, and this idea of like, we want to be creating a product, property investment, that allows people, the safe and happiness of rental accommodation, which is great. I've got no problems with that. But all the other stuff has decimated it. People are living in droves. Property investment as an asset class as a result of that. So, but back to the bubble thing, and I mentioned it beforehand, the government is highly incentivized to ensure the inherent value of the Australian real estate. They will do everything they can to make sure that it doesn't tank.
Can I tell you something funny?
Banks are the same. Superannuation funds are the same. If you mess with that, if you start messing with Australians' wealth,
mate, the system collapses.
It's just the whole system collapses.
Quite literally, Australia's financial system will collapse.
Yeah.
I'll tell you something funny, because you mentioned the IMF before. When you actually read the IMF report, oh my gosh, like they just lash it for being demand-side stimulus. Yeah. It's like the fact that you've got nothing, that you're not building anything, and you're giving people the liquidity to buy. This in part is a PPOR-led surge, and you already saw in the first month of the 5% deposit scheme, 5,500 people buying. 10% of all purchases were people on that single scheme in the month of October last year.
But Treasury told us it was only be a 0.6% consequence to property price over 6 years or 5 years.
To your point earlier, you said these people look through the microscope at it. Mate, they're looking to a freaking kaleidoscope. They're off with the pixies, right? I caught myself before I got passionate about that. Mate, they're looking through a kaleidoscope. I don't know what they're imagining with that. The IMF lashed it. Now, the Housing Minister Claire O'Neill on Facebook, and I thought this was the funniest thing, because I love reports. I love reading.
Nerd.
I'm a nerd, right? I'm a nerd. But she posted something on Facebook talking about how with the 5% deposit scheme, Australians can save up to $160,000, and it was this weird reflexive report, maths from a KPMG report. Basically, also the maths was quite wrong. So they were basically saying that the average house price in Australia, or the average home price rather, is going up about 7% a year. So they compounded. If you got onto the asset class now, if you bought a home now and you project it by 7% year of growth, given that you can get in 5 years earlier with the the 5% deposit scheme, this is how much money you're going to save, because it's going to be compounding at 7%. You're going to save about $160,000. You're going to make $160,000.
Saving or manufacturing?
Well, both, I guess.
Okay, yeah.
Few things wrong with that, because obviously not every asset class is equal.
Yeah.
If you're in Sydney and you're using the 5% deposit scheme, I can almost guarantee you're going to be buying a very average new build apartment. That's not going to be going up at 7% a year. Actually, in a lot of areas, it's gone backwards. So you've just applied the incorrect growth metric to the incorrect asset class. You're telling people a lie there. But it's very funny because she posted this on Facebook saying, with like a dance or something, saying, oh, look how much money we're making for young people.
Yeah.
The next paragraph, clearly her staff didn't even read the bloody report, because the next paragraph then went on lashing the government for saying such a massive drive of the new demand for housing is for young people buying assets that won't grow, and it's leading to higher asset prices. Yeah. And clearly, you didn't even read your own report, that the KPMG report that you're talking about how good it is. In literally the next paragraph, it says these demand side stimulus, it is actually pricing people out of the market now.
So, Minister O'Neill, you've been in this studio before. You know us. You like us. We have a spare microphone here. We'd love for you to come and have a yarn with us, and give you a fair crack at sort of explaining a lot of these what are, and I know, quite complicated and difficult economic chess that we're playing here, right? Like, and back to the point, it's Australia is so intrinsically, back to this bubble thing, property is so intrinsically connected with the health, happiness, future of Australia. It's a nation building imperative.
Not complicated. I mean, these people respectfully have really set people up for failure. You and I have spoken about it at length.
Don't start me.
As a young Aussie, I get very worried when I look at friends that are taking up this scheme and they're buying crap assets because they've been promised a lie, and the maths doesn't stack up, because it's like you're one redundancy away from having to fire sell this place.
Negative equity.
I've been harping on about that for months. We have the economic complexity the same as Botswana.
I hear about this. We're going backwards in terms of our the sophistication of our economy.
We dig stuff up and sell it.
Yeah.
And we have stamp duty.
Yeah.
These are the two things that our whole financial system, our whole tax system is built off.
Well, back to our back to the discussions around changing to the tax regime. Be very, very careful, Mr. and Mrs. Federal Government, because if you try and increase taxation receipts through property investors at a federal level, the consequence of that will be less taxation receipts at a state level.
Yes.
Because you'll remove liquidity from housing, because people will probably hold on to assets rather than sell them. And if people aren't trading real estate, what happens is that there's less sales, and if there's less sales, there's less stamp duty to collect. And if there's less stamp duty, we've already got big, bloated, fat state governments. They're going to be looking down the barrel of huge deficits. And where are they going to start looking for more dough? They're going to be taxing Australians more at a state level, and or they're going to be turning to the state government looking for more dough. Yeah, you might even have GST consequences.
Yeah,
with that,
you and I spoke about it last time. When they were first raised the idea of CGT reform, and I said to my wife, I'm like, oh, what's this going to mean for us? She's like, oh, we just don't sell. And I'm like,
it.
Oh, yeah, that's that.
Or you get different structuring, and even these, some of the suggestions I'm hearing around negative gearing is, you'll only look. Mate, they don't know what they're doing, right? And there's people down there that probably don't really understand. They probably still think in some corners of bureaucracy in Canberra that negative gearing is a property strategy. There will still be people who think that. The amount of misinformation in this space is huge, i.e. people just peddling stuff that they've heard. But there is deliberate disinformation. A lot of that is originated out of politicians saying certain things to try and shape a particular opinion, and it's base disinformation. And if they can't rely on the people inside the bureaucratic engine of Australia to provide them the information they need, mate, you see them squirm as Senate estimates. I've really enjoyed the last round of that. Like it scares me.
Who's the finance minister?
Gallagher.
Oh my gosh.
Yeah.
Yeah.
Like I just sit there and I just go.
Yeah.
It's like, anyway, she's the CFO essentially, right? You know,
It's mind-blowing. And I couldn't agree more about the negative gearing argument, because...
So they're saying two. You can do two. But they're going, you can only do two ever. So what happens, back to my point, say if the thing is that you can only ever negative gear two properties. So is that an individual, Phil Tarrant, I get two, and then, you know, my partner gets two, or is it two together? And it's that two forever. So once I've done two, let's just say I negative gear it for a year, and then I offset it because I got some dough and it becomes positively geared. Do I get to do another one, negative gear? Can I have two in motion at any point in time, or is that's all I ever get? Right? It's going to be so hard. Good luck trying to put the guardrails around this, or the rules and requirements around it, because it's going to be a mess. Anyway, they've gone to two elections trying to take it out in Australia and said no. So don't mess with it. This comes back to the bobble point. What I want to get also, we're debriefing on the week. What else have I seen? And I sort of, this raised my attention, was legislating work from home for small to medium businesses in Victoria. And I went, you've already got an economy that's stuffed. Like, it's stuffed. And now you're sort of disincentivizing Australian Victorian businesses to invest in growth.
It's appalling.
And the story you get told saying, oh, it's going to be better health and happiness for people. It means that they're going to save money because they don't have to travel to work. Like, fine. And I sort of understand and appreciate a lot of that sort of stuff, right? But the issue I have with it is that the type of jobs that you can work from home in are not the type of jobs that we really need to get a huge economic shift in this nation.
Yeah.
We need more builders.
Yeah.
We need more tradies. We need more carpenters. We need more electricians.
Small
we need
business
more
owners having a go.
Small business owners who would drive. But by the way, right, back to the states, right? State governments don't pay payroll tax. So all those people all of those people who receive a salary from the state government, they don't pay payroll tax on that, right? So payroll tax is provided by the private sector, and the majority of the private sector are small to medium businesses. I think there's 3,500, maybe 4,000 now, ish, large businesses in Australia. So these are companies with more than 200 people.
Yeah.
Why are you having a crack at the engine room of the Australian economy, who provide the majority of the taxation receipts? Payroll tax at a state level. They employ Australians, so they obviously paying the tax for them, company tax, etc.
Yeah, it's appalling, and I use the term laptop class, because the political bubble is so. And I'm going to put the APS in this because I met people that work in the APS, and work ethic. I'll leave up to our listeners to get where I'm inferring. But
we're not saying everyone.
I'm not saying everyone, but I use the term laptop class. I'm in the laptop class.
Yeah.
Reasonably, I can grab a microphone, grab my laptop. I could go home after this, and my work will still get done, more or less. Yeah. But what about the nurses, the builders, the fireys, the cops, the people that actually make our country great and actually are delivering the services that we need? The barista that's on his feet from 5 a.m. in the morning making coffees for tradies on the way to work, and he's standing for 8-9 hours, or she's standing for 8-9 hours. These people don't see the benefits of this legislation. It's vote buying for why I call it the laptop class, because then you can go home and hang out and have Netflix on the background and look after your dog and go for walks and do your dry cleaning in the middle of the day and cook lunch. And these are fine, sure. But we're in the middle of a productivity crisis. Like, quite literally, our productivity is dropping. And Tom Panos did a fantastic video on Instagram a few days ago where he said, this is where we're seeing a disparity. Productivity is going down, government spending's going up, so we're paying more for less.
Yep.
as a nation, we're producing less and spending more.
Yep. And that's quite simple. And
It's
let's
that
remember
simple.
also is that I think we've got the biggest public service as a percentage of population anywhere in the world. So we have big government here in Australia right now. Who pays for that? It's the small and medium business, and obviously larger businesses contribute to that at scale. So yeah, that's I heard that and I went, that should be a decision of the small to medium business operator to make that an option. And look, I'm not anti work from home. I think there's some sort of merit to it, and at certain sort of times, and depending on what the rhythm of your company is. But to actually mandate it, like, again, you're taking power away from the people that pay the bills, and already they're getting hammered, right? I know there's a lot of small to medium businesses who are really, really worried about same day super payments, right? Like, that's going to be a big deal for a lot of small to medium enterprises. And what happens if that becomes a consequence? Well, you get greater insolvencies or people downsize their business regime, which means that there's less Australians employed. That means there's less tax to receive from them. You need to be incentivising the small to medium enterprises in Australia. The Australian government doesn't even talk to them. I think they think, we'll talk to one or two union or lobby groups who, inverted commas, represent small to medium enterprises. They don't care. They just don't care about small to medium businesses. They'll pay lip service to them, but they just see them as a checkbook. Just let's go take. And then I see also, the week in debrief, the unions have come out this week saying, we need to give another week of statutory holidays.
5 weeks annual leave.
Five weeks annual leave. And I'm sure a lot of Aussies are going, great. And their argument and justification is a lot of people work and don't get paid for it, and this will help with mental health and all this sort of stuff, right? But someone's got to pay for that, and it's the businesses that need to pay for it. And if you start messing with the small to medium enterprises in Australia, they're just going to employ less people.
Yep.
That means you're going to have more people sort of turning to the government for, income, whether it's the dole or some other sort of, welfare benefit, which I think the government wants. Yeah. They want more people reliant on the government than less reliant. And that's not the Australian way.
And that's the thing that, I was reflecting on. I know you and I have pulled it apart to death, but CGT. At what point is it good politics or good nation building to have cheaper homes? That's one part of it. Yeah. At what point is it to increase government coffers? At what point is it to just punish property investors? And which camp is it? Because I think there are three camps that it could fall into. Now, if you're looking at the affordability camp, like we were talking about before, you only pay capital gains tax when you exit your position. Yep. So I've got a property and I'm going to put it on the market. I'm happy to sell it and leave. Great, you've actually increased supply. You've increased stock on market. Fantastic. More of that's actually going to decrease property prices. But what you're doing is you're disincentivizing people for putting it on the market. They're going to hold it longer. Listings will drop. Property prices will increase. So is it about, punishment? If you actually wanted, and it's a bit of a dangerous idea, and I think everyone in every inner city seat is about
podcast of dangerous ideas.
Well, everyone in every inner city seat's about to demand my head for this. But if you genuinely wanted to increase affordability, why not decrease CGT? Because if you're saying I'm actually going to incentivize Phil Tarrant, I'm going to incentivize Liam Garman as a property investor to list their excess properties, to actually put them back on the market, to increase stock so property prices go down, we'll lower your CGT so you can pocket the cash and list them. Hey, that's a dangerous idea because you're actually incentivizing investors to sell from a good point of view.
Maybe.
Dangerous idea.
Yeah, dangerous idea. So, this sort of work from home type thing. Look, what does it mean for property? Well, it means that regions will become more attractive if it's actually mandated and practical for people to maybe work 3 days a week or only have to go in the office 3 days a week. They've probably got maybe greater intentions to sit on the train a little bit longer for 3 days a week rather than 5 days a week to head into town. It might open up some of the satellite sort of regional locations in Melbourne, Victoria, which so there may be some consequence there to property markets. But watch this space on the union side of things. Unions represent 13% of all Australian workers. So
not much, less than you think.
Less than you think, and you would think the attention that unions get, again, this is the issue, the attention that unions get and the voice that unions have with the government in determining the policy settings around our workforce. They only represent 13% of workers. However, they're overrepresented in shaping decisioning around how Australian workers work. And I think there's a huge misalignment there. I'm not a union beat-up type person because I think unions many, many years ago did great work for helping workers' rights in Australia, particularly in manufacturing and blue-collar type environments. But that's not Australia anymore. And I don't want to get into manufacturing as a sovereign capability because we need to be working on that. But don't allow the unions to overrepresent decision-making in our state capitals and our federal capital in relation to how workers work. They've got too much of a voice. And you only need to look at what's happening down in, again, Victoria. The fact that, what's the number now? Union rorts, so worth $15 billion more to the Australian taxpayer because of the rorts that have been taking place around unions. Come on.
The good stuff that the unions did, right? When I think of a good union, it's unsafe work site, coming on, making sure it's safe so someone doesn't injure themselves. But we know what the CFMEU was doing, and they were letting their people work on unsafe work sites because it was a developer that was, related to a bikie that was hired here, there, and everywhere. It's not even about safety. It's just money making broad. And actually, and I'll give the government credit when they disaffiliated or they
put an administrator in place.
Yeah, they put an administrator into the CFMEU.
They're still working through that. And bold job. But Jacob, we have another question.
Recent 2026 data points to a looming regional liquidity trap with rising vacancy rates in regional towns compared to a massive rental crunch in capital cities. Is the regional property boom officially dead, and should investors be offloading underperforming regional assets before liquidity dries up entirely?
Okay, not every region's equal.
Quite a lot to that. Yeah. So the point around offloading ineffective assets. So the question is, if you didn't hear it, there's a liquidity crisis happening in the regions. Whether or not I subscribe into that point, I don't really have enough information to have an opinion on that. But and whether or not you should be getting out of the regions now before everything tanks, right, is the question. So if you got less than ideal performing assets, irrespective of where they're located, you should be assessing that. You shouldn't be holding on to assets that aren't performing. Yes, a lot of the times you've got a lot of sunk cost into it, but sometimes you're better off just cutting your losses and getting out of it. The governments are doing a lot to try and encourage people to move out into the regions. That's taking place right now. You see adverts popping up all the time about all the reasons why you should go out into the regions to create a family and a lifestyle and stuff. And I just subscribe into that. But for a lot of the times, it's just not a practical reality for a lot of people. That's nice. And the stories you see around this is normally for doctors and nurses and teachers and like public service type people. Yes, it's jobs in the regions are often a lot easier to secure and sustain. But for people who work in business, those opportunities are a lot less few and far between, particularly if you've got to be in the office all the time. So, it's this dichotomy between how do we build our regions? How do we get more Australians out into the regions? That's one side of things. But whether or not you should be investing in regions, if you speak to some property investment advisors, they will go to great lengths to show you why the regions outperform the capitals all the time. And go and look for this data. You'll see it all the time. So I don't subscribe into the point that the regions are supposed to face a big liquidity crisis, and that would assume by that meaning properties are going to stop trading or transacting rather than the inherent value of them are going to decrease. I don't know if you got a view on that, Liam.
Well, not every region's equal, right?
No.
Were you ever on the Townsville bandwagon?
No, I've never touched any of that stuff.
Yeah.
Like everyone up in where's it's Townsville.
Where it's like tripled in the last couple of years,
Philip Thompson is
MP.
Yeah, Townsville's gone nuts.
Yeah.
Cairns, these sort of
but I suppose
Sunshine Coast.
There, not every regional town's the same. Look, not to bash it because it's performed really well. Are there regional towns which can support a $900,000 house price? Probably not. That's really pushing it because you do have to have a base level of income such that locals can afford to buy it. If you're expecting to exit one day, people have to be able to afford to pay for your exit strategy. So, yes, there are limits to regional towns. Not every regional town's the same. You know, would you consider the Byron Bay regional? Well, maybe the areas like that in the Northern Rivers, they do seem to be going backwards. Not financial advice. You can check it online. Yeah, like some of those.
Nothing here is advice. It's
Nothing
not even
here is
sensible
advice.
conversation.
Some of those Northern Rivers, Northern Rivers towns are going backwards, but that was because there was this absolute herd mentality during COVID and everyone moved up. And to your point, some people now have to move back for work, all of that. So, yeah, some of them are paring back. On the flip side, there have been regional towns that have just been undervalued. I don't think you can put them into a monolith.
Where and maybe what was the name of the person that sent this in, Jacob? There's no question. So look, what I would say in relation to this, and it's sort of concurrent with Liam's point, is that not all regions are created equal, and there are a lot of different dynamics to regional towns. Now, if you're going to be investing regionally, you know, there's some basic tenets that you really need to be looking at: diversified economies, certain size, you know, infrastructure that's there, everything in connected with it. But, and maybe this is what the question is alluding to, there are certain regions which get identified by one or a cluster of buyers agents which heavily infiltrate those regional markets. And you see it, and I would probably throw. I'm not going to have a position on Townsville because I don't know enough about the specific economics of it. But anecdotally, that has had a lot of activity and price growth. How much of that has been fueled by property investors and with the support of buyers agents versus owner occupiers? I'm going to say it's going to be heavily weighted to the former rather than the latter. So one or two buyers agents will get into a regional area, and then every other buyers agent will follow suit. What happens? It puts a lot of pressure, supply and demand. There's a lot more demand for properties where the supply is, and that will naturally drive prices up. So is that inflated, or is that a micro bubble? Potentially. So this is what you need to look at. So what happens if people start selling down all those properties because for whatever reason, capital gains tax things comes in, people start dumping assets, you're going to drive prices down pretty quickly. So you're going to end up with people holding property which probably is not at the value, the inherent value what it was when it was bought. Yeah. So maybe this is what the illusion that they're alluding to. So I'm not saying that is Townsville per se, I'm just using that as an example, but a lot of the price growth there has been driven through investor activity.
Yeah.
Absolutely. So is there enough renters there? I don't know what the rental stock is like at the moment. We can go and have a look at that. I'm starting to see similar, and I'll probably get some hate mail by saying this, but Darwin is a regional town. There's a lot of activity now in Darwin. Darwin's done nothing for years. A lot of people say stay away from Darwin. There is a lot of buyers agents active in Darwin right now, and you're going to start seeing it. And I think the Fast 50 report, which is coming out soon, actually has some Darwin suburbs in it.
Yeah, a few,
And that has a bias, the Fast 50, as in where to put your money today for the best capital growth in 2027, right? So if you have a flurry of activity in these regional locations driven by buyers agents or property strategists, you're going to get an uptick in pricing.
Yes.
That's driven through the demand of people thinking that they're a good place to invest. Now, if you get in early in these cycles, you probably get the upside benefit from it. So bubble activity, I don't know. I'm not investing in Darwin. I can't see myself ever investing in Darwin. I don't need to be investing in Darwin. However, a lot of the recommendations are out there. So if you want to play that game, be very careful. If you do subscribe into these sort of bulk activity where buyers agents are operating to get the upside growth, which you will get, that's fine, but be careful of the downside.
I mean, and that's what goes back to our point earlier, which is it's not a get-rich-quick scheme. It's not a shortcut. You do have to – it comes with risk. Everything's going to come with risk.
Risk and return, just going with eyes wide open. I think, Jacob, we've got another question. This is lots of questions coming through. This is going to be hard to manage this moving forward.
Yeah, I know.
Yeah.
This is from the user Zima. Got an opinion and also a question.
Yep.
Opinion being,
why don't you come down here and you can actually speak into the mic? Here we go. We're bringing Jacob on air for the very first time. He's hidden behind the shadows.
You can share mine. There you go.
He's coming there. Yeah.
Right.
Yeah, here we go.
So Zim is saying the regions are gold. Look at government strategic towns.
Yep.
But then also asks, do you think the government will skip the depreciation in capital tax and play with the land tax?
Oh, well, they really sort of tinkered with land tax beforehand and trying to. I think they implemented something some time ago, and they pulled it back where you could either opt for paying land tax from the point of time of acquisition rather than paying stamp duty. Either way, the government's going to get whatever they need to get out of it. To that point, though, Jacob, the governments, and I'll talk about the government. Government is federal government and state governments. Here's another dangerous idea.
Oh, we love dangerous ideas.
If you want, and it's a good idea, and I never thought about this before, so this is policy making on the fly to our friends down in Canberra.
Oh, isn't that how all policy's made nowadays?
If you want to incentivise people into the regions, and if you want to make rental accommodation more affordable in the regions, if you're going to tinker with CGT, you can make CGT discounts different at a geographic level. So, you might want to keep your 50% discount for people investing in regional locations. You might want to keep your negative gearing for areas which are regional outside of the capitals. There's a dangerous idea, but I hope someone sort of thought about this. If you want to start messing with increasing tax coffers, but trying to get the upside benefits of incentivising people into the regions, why don't you? Here's another bold idea. Why don't you just cut or halve the stamp duty for regional purchases? You're going to get people out of the regions pretty quickly.
Yeah, absolutely.
And if you want to start actually getting people to create businesses in the regions, if you want to get people investing in the regions, and to the point, there's a lot of regional locations, which are large regional locations, great places to live, raise a family, build businesses and stuff. Why don't you tinker with that geographically? Good luck. You've got the postcodes there. You've had Australia Post around for 100 and something years. You know the local government areas. You could do that pretty easily. Anyway, policy make on the fly.
On the stamp duty note, so the coalition, and I just had to check it then to make sure I wasn't.
I was trying to hold it while you.
I was quickly Googling.
I was trying to remember what it was. Yeah.
The coalition in Victoria came out proposing to abolish stamp duty for all first home buyers up to $1 million.
They already get a stamp duty concession anyway.
Yeah,
right?
but I think it must be a lower.
600.
Yeah, it must be. Yeah. So
get them out to the regions.
Yeah,
do it. Say no. There's no stamp duty if you want to live in the regions. No stamp duty out of Melbourne.
But that'll lead quite a good owner-occupied PPR buying surge.
Yeah, it will do.
Yeah,
great. Cool. There you go. Another point. This is a debrief, a weekly debrief. Something else I saw and myself, and a lot of people don't know this, but my actual job is not being a podcast host. I'm not just a podcast host. My real job is I'm the CEO of a technology company called Managed.
Tell us more.
So what Managed does is that it's a property management operating system that allows property managers to operate more effectively. And I don't want to go too much into it because people are going to start yawning and going whatever. Anyway, the key thing is that it's removed the trust account from rental real estate transactions. So I'm a property investor, as everyone knows. We invested into this product because we went, hang on a second, that's what we want our property managers to use for our thing. So essentially, when the tenant pays their money, everyone gets paid straight away. So typically what happens if you're using a property manager that has a trust account is that when the tenant pays, the money goes into a trust account. It sits in that trust account sometimes for up to a month. And then at the end of the month, someone in a real estate office sits there and works out who needs to get paid, and they manually they go through the ledger and they manually work out, well, Phil needs to get paid this much money for the rent, less the council rates, the water rates, our fee. The property manager obviously gets a percentage and everything. They work it all out manually and they start processing it all. What Managed does is does all that automatically and instantly. So when a tenant pays me, as the property investor get paid, I put the money in my trust account.
Straight away.
Happy days, I'm saving. All right. And everyone else gets upside benefits and stuff. If you're interested in this, go and check it out. It's managedapp.com.au. But a key thing around it was it removes the opportunity for people to nick money out of the trust account, right? And you'll be surprised, and no doubt there's a heap of stories around this, where people's rent money's gone missing because some dubious operator, an agent or a principal or someone has nicked the money from the trust account. So managers got rid of all that. You can't do that anymore. It's all the good stuff around it. And also, second or third order effect is that money doesn't go missing from trust accounts, which is hugely antiquated. The rules governing property managers in Australia are old. They're as archaic as you can imagine, and it's had very little sort of love spent to it. So Manage is working towards creating a new regime for that. It's happened that suits the tenant, suits the landlord, suits tradies, get paid straight away, and it's really good for property managers. So that's my day job. That's sort of what I do. But, we're debriefing on the week, which gives me great exposure to a whole bunch of things going on in and around property market and what's happening in Canberra and all this sort of thing. But I know there was a couple of stories coming out around more trust account thefts.
Yep.
And I just go, and I sit there just going, yeah, I told you, we're trying to help you here.
Now, I also have another job.
Ooh.
I'm not just a smart property investor and podcast host for this.
Okay.
I also run Real Estate Business,
You do?
which is SPI for agents.
Yes.
It's a trade publication for people that work in property, so real estate professionals, agents, buying agents, property managers, etc. And it's every week at least, and I'm talking like large scale thefts.
Yeah.
The large scale thefts, it's weekly.
Like how much large scale? Like, 50 grand?
Millions?
Oh, okay.
These are big, right?
Yeah,
so
yeah.
if you have, for our listeners, a property manager, think of it really is an investment manager, right? They're looking after your assets, view them as an asset manager. Now, if they've got your property and 1,000 others that they look after, that's hundreds and hundreds and hundreds of thousands of
money.
dollars washing through this every week, right? Every week. Over the course of a month, we're doing millions of dollars coming in over a month. It's very easy. Dip your finger in, take a few $1,000s here,
Just for a little bit. I've got to meet my
and when you've got
bills.
so much going through the wash, people don't really pick up on it, right? So what you do end up finding is someone's had their fingers in the till for a year or two.
Yeah.
They've taken 50 grand, they've taken 100 grand. Some people, we did a story recently where someone took $2 million, right? Over a long period of time. But when you're dipping 50 grand here and there over several years, it sums up.
Thinking we'll get away with it. No one will know. We'll get away with it.
And
It's a bit of a Ponzi scheme,
well, that's
right?
it. And eventually it comes to a point where, you go to sell your agency or this or that happens. And for whatever reason, the wash of money stops and dries up. And there comes a point at which,
the song stops and there's no seats
there's
to
no
sit
sheet
there.
left.
Yeah.
And now you've got 1,000 landlords that are down, $3,000, $4,000, $5,000 each. Oh, that's a problem. And no more money coming in because all the tenants have paid. The tenants have done their job. They've paid. But people have had their fingers in the till for a couple of years, and we've seen it, weekly.
Yeah.
Weekly there comes a point at which landlords are suddenly left being owed $10K, especially if you've got multiple properties listed with the same property manager, and they're owed big sums of money. Well, there's just no money left. So
So it happens.
yeah,
Unfortunately, there is a better way. Just saying,
it's there.
it's there. But
Ask your PM. I do.
Well,
I always ask my PM to make sure that I'm managed.
Newsflash, you can actually. It's the first time I think this is ever sort of coming out. You can actually now find a managed agency.
Ooh.
So we have
tell.
a new thing. So if you go and check it out, and this is really an exclusive for the weekly debrief. It's a new platform, investor platform called Spike. Spike.com.au, spike.com.au, and essentially it's an engine for helping people find a managed agency. So if all of this sounds good, and you go, number one, I want my money straight away. Number two, I want absolute transparency on payments. Number three, I want the resources and the tools to be able to better manage my property investment. So you can download statements, you can get over your list. So essentially, you've got control over stuff rather than having to go to your property manager all the time, asking for stuff. And number four, if you actually want to find out where these people are, there is a great tool there now available. So you can click on it's called Find a Next Gen Agency. And our Jacob is showing it right now. So we're doing a lot of work at the moment in relation to helping property investors better manage their investments. And the core focus of that is, you've got two types of agencies, right? You've got legacy agencies and you got next gen agencies.
Yeah.
So Spike will help you find a next gen agency, and next gen agencies understand and appreciate the value of direct and automated payments for their landlords. They're forward leaning, they're growth agencies, they're embracing change. Property management is still stuck. It's been overlooked for way too long, the machinations of how these agencies operate. So next gen agencies are growing rapidly, and they're creating a lot of value for their investors. So if you want to find a next gen agencies use managed, go to spike.com.au. There you go.
Yeah.
I didn't think I'd be talking about that right now, but there you go.
But it's good.
Go and check it out.
Like people can go online; it speaks for itself.
Yeah, some great news on there, some great resources and assets. And if your property manager uses, or if your property manager is a next gen agency that uses manage, it's a whole bunch of really cool tools you get as well. So anyway, we can chat more about that later. But that's pretty much the week.
I think that is the
week in
week.
brief. I'm just trying to think what else has come across my desk. What's that?
one more
Another question? Yeah.
Okay, so for an everyday investor holding a portfolio of 3 to 5 properties right now, cash flow is likely incredibly tight. In your view, is 2026 a year for aggressive accumulation if you can get the finance, or is this the year of the portfolio health check, consolidating debt and trimming the fat?
I'd say both. The question there is in relation to should you really be consolidating right now and managing your cash flow, or rapidly growing your portfolio. What I would say is that as an everyday investor with 3 to 5 properties, you're not an everyday investor. You know, you're within the top 10% of the Australian of Australian investors. I think the number's like 90-point-something% of all property investors own between 1 or 2 properties. So you're not an everyday property investor. If you have 3 to 5 properties, I'd say you're sort of at the top end of that. So the fact that you're doing that is a good thing. It means that you've made some really smart and sensible decisions up on this point in order to build wealth. I always sit in a cycle of consolidation and acquisition. I've sort of spoken about this previously. So you always need to make sure you got the best portfolio you possibly can have at any point in time. And if you're not thinking about yield and you're not thinking about cash flow, you're never going to achieve that. So you need to make sure your interest rates are right. You're not overpaying on that. You may be needing to refinance your properties. If you bought property and held it for some period of time, and maybe you bought at 90% LVR and now you're sitting at a 60% LVR, you've got to be negotiating with your banks to get in those interest rates tightened up. That's the cash flow play. And where you can make the biggest bang for your buck is the biggest expense, and that is your interest. If you're not concentrating on that and looking at it regularly, you're going to be behind the 8 ball. So make sure your cash flow position with your current portfolio is as good as it possibly can be at any point in time. And therefore, you can also look at abilities to leverage some of the equity you have in those properties to keep buying. So both should be done simultaneously. This sort of perpetual interconnectivity between acquisition and expansion versus cash flow and consolidation. That's what the best investors do, Liam.
I mean, it's hard with the question, like, are you accumulating for accumulation's sake? In which case...
Well, where are you going? Why are you doing all that sort of stuff,
I mean,
right?
you have to do the basics right, because with the regional examples that we gave before, you know how regional's regional, but you don't know what 2026 has got in store. You know, if you've bought regional, and we already know property prices are more expensive out there. This is just an example, but we already know property prices are more acutely felt in regional areas, just with the logistics costs of getting there. If you're already seeing potentially $4 a litre in Sydney, then there's going to be some real price point pain in some regional towns. How much is that going to impact them? How much could it impact the local big employer? Is that local big employer going to shut down? So I would always urge against and advise against accumulating for accumulation's sake.
You've got to know why you're accumulating. You need an exit. Don't buy for buying's sake. And what I would say, and this is a really important point, thank you, Liam, is that 2026 is not the year for buying properties. 2026 is the year for building a portfolio. And building a portfolio may mean that you're not acquiring anymore. Building a portfolio is holding a portfolio. Building a portfolio is ensuring the economics of that portfolio as good as they possibly can be. So don't view this through the lens of buy. This is about build. And building a portfolio may mean downsizing your portfolio. All these things are interconnected. So change your mindset and change the way you view it. And unfortunately, because of the reams of property podcasts out there right now, the amount of information around property investment, most of that information is from people, and I'm going to probably get called out on this, but I'll say it. Most of the information in the market around property investment has a bias. And that bias is it's produced by people whose businesses are about helping people buy properties. That's the way it is. And that's okay. You just need to understand that. So, if you're consuming information which is saying buy by certain people, that's the reason why is they make money by people buying property. So hopefully you can come here with a view towards without bias or agenda. It's about build, and build might be getting smaller. Build might be changing the economics of it. Build may be, working harder on your administration or changing the way in which your cost base is growing. It may mean building a granny flat. Who knows? So you've got to be thinking about it that way. So don't get consumed to think that if you're not buying, you're not achieving in property investment. It's very different. Anyway, Jacob, anything more?
Yeah,
We can keep going. That's might as well.
I
Yeah.
set up a podcast in the other room, so
Okay.
we've got another hour.
Oh God. Yeah. Yeah.
So Brad has asked, hey guys, have some equity but limited borrowing capacity. Is it still worth exploring the trust structures with recent changes to lending?
No, well, I actually put a thing down here around trust. Again, so speaking to, and I can pretty much speak to every buyer's agent in Australia, right? And I speak to and there's a lot of misinformation around this, and I'm probably, I'm not a participant in that misinformation. However, you need to put things into perspective. And if you listen to certain podcasts or consume certain amounts of information, you would think that every single person is investing in trust-based structures in Australia. That's not the case. And I go and check out Ben Kingsley's videos, and he gives you some sense of it all. So you think if you're a property investor with multiple properties that you're investing in trust, that's certainly not the case. And I know a lot of property investment advisors, the first thing to do is to recommend trust-based borrowing for every single customer that comes to them. And I would say tread with caution there. I know other buyers agents who say we don't recommend trust-based lending. 95%, 99% of all of our clients invest through their personal name, and that still is the currency for most Australians. So a lot of the themes and a lot of the concepts and a lot of the strategies around trust-based lending has been hijacked by, again, people I would say with a certain bias to get people buying more property from the absolute get-go. And this is about preserving or conserving your ability to continue to buy because you have serviceability restraints. So what typically happens is that you invest in your personal name and eventually the bank will say, it's out of kilter now, your debt to income ratio, we're not going to lend you any more money. And that's prudent, right? And that's most Australian investors, hence the reason why 90+% of all Australian investors have between one or two property. That's the structural floor or ceiling, for most Australian property investors. And that's the reason why that stat takes place. So if you want to start investing in trust, you need to be doing it for particular reasons. Now, the government's clamping down on it, and lenders have clamped down on it. And rightfully, lenders have clamped down on it because it's been misused in many ways and hijacked. And you see Macquarie Bank come out first last year, Liam, pretty much going, we're cutting off trust-based lending or structures, lending to company structures because of growing, I think the quote unquote was a growing proliferation of advice around trust-based lending. The banks have jumped on it. They've curbed it. The government is looking at it as well. And there's been a lot more oversight put on accountants who have been, and I would say some of them complicit to providing information which is not actually true. And that's a fact that this idea that if your trust is in its own sort of holistic bubble is positively geared, lenders won't consider it from a servicing point of view. So some accountants, and I would say certainly some, not most, but some accountants have been providing information on that basis for the support of people to continue to invest in trust-based structure, and whether or not, and I've got to think more into it, how much of that is actually being driven by buyers agents pushing those agendas, I don't know, but there's something in it. So the question is, Jacob, whether or not keep investing in trusts. I can't answer that question. I'm not an accountant. I'm not a financial advisor. all that sort of stuff, you actually need to go and speak to the right professionals around it. And what I would say is that don't go and speak to a buyer's agent first about it. Go and speak to a financial planner and go and speak to an accountant from a structural point of view, whether or not you should be investing inside a trust. And most people, most property investors, don't need to invest in a trust. Now, if there's changes to capital gains tax or negative gearing, that may change things. But there's always ways in which people will maneuver around these things. There's always a new way to sort of circumnavigate any changes to policy or the settings, whether it's from the prudential regulator, from your bank or from your government. So I'm not going to say go and invest in a trust. I can't say that.
We've heard so many, just on the SPI show and some of our guests, there are some examples of where it's been done really appallingly. Really appallingly.
Oh, horrible.
Examples of people, having a trust per property. And you end up having like 12 trusts.
We've had mortgage brokers come on saying that people will come in and what they'll do is go and see the 4 mortgage brokers and try and get a pre-approval simultaneously in 5 different trust-based structures so they can continue borrowing. And I sit there and just go, it's madness.
It's madness. And I think a lot of people could end up in a very bad situation. Yeah. Because they're just getting bad financial advice from people that legally are not able to give financial advice.
Yeah. And I think this is going to be a theme for moving forward. And if you're buying those properties in areas we spoke about, which may be sort of fueled by, if rapid price growth is fueled by other property investors, you might find yourself in a spot of bother.
Oh, of course. I mean, but that's what we're going back to. It's a case of, it's not a get-rich-quick scheme. There is inherent risk with that. Yeah. I did a great podcast a few days ago, and it actually should be coming out in the next 24, 48 hours with James Nealis. Now, James was a AFL...
I know James.
AFL, great guy. Yeah. AFL star, and he does a lot of BA work for athletes. And he takes the perspective of... his sporting background into this. And he said one thing that people always overlook, and I can't remember his exact sentence, but the crux of it was, you have to last the game. You have to last the ups and downs. Sometimes it's going to be a down, sometimes it's going to be an up, but you have to make it through. You can't put yourself in such a precarious financial position such that at the first bump in the road, you suddenly have to sell. You have to be able to weather the storm. And, the best athletes, I guess, at the end of the day, are the ones that can last the game. They don't get gassed out. And it's the same with this.
Absolutely. All right, Jacob. Is there another question? Is there?
Rolling through.
We'll keep going. Well, people are interested, obviously. So thanks for tuning in, everyone.
Hey, Phil and Liam, any chance you're interested in mentoring or doing portfolio reviews on these live streams? I'm assuming they're referencing these live streams.
Yeah. No. I won't be doing that, and I'm not qualified to do that. However, I'm sure we could find someone who would be happy to come in and do some live reads. So it would be completely inappropriate for me to do that. And I don't even do that inside of work. People come to me, my colleagues saying, "Oh, Phil, should I buy this property?" I go, "Man, I'm not going to give you that. I can't do that. I just can't do that. It's just completely inappropriate." To get down to that micro level. Look, I know I do it myself, and I critically analyse my own stuff, but I'm not in the business of providing property investment advice. You need to go to the right qualified operator in that regards. However, what I would say, and there's a certain bias to this, make sure your property manager is usually managed if you want to get paid straight away. But we can find someone that can come in and do live. Live portfolio reviews. Yeah, that'd be cool.
Yeah, let us know in the comments. If you want an accountant, if you want a broker, we can bring them on.
Yep, happy to do it. And if people are keen on that stuff, absolutely. And I'll provide commentary as a sort of armchair commentary on the portfolios, but we need qualified advisors to be doing that sort of stuff. So whoever this is, if you want to respond to them saying, "Hey, if you're up for it, send your portfolio through, we'll get someone in."
I could. I'm wondering, I can set up a little Google form.
Yeah.
People can apply to have their portfolio looked at on these screens, maybe.
Do you know there might be a way in which we can use? Go and check out the spike.com.au tool, because it actually allows you. It's got a full portfolio tracker inside of it. Okay. So if you're a logged in person, you can actually map your whole portfolio through that. So maybe we can use that as a way to do that.
Submit the
the stuff. Yeah, that's cool. It's a good idea. Thank you. If there's a name, is there a name on that?
Zima.
Zima. Yeah. Yeah, but thanks, Zima.
All right. Well, I'd be happy to do it. We'll be very interested to see what they say about my portfolio.
Okay, cool. Great. Oh, that's a great idea. Thank you. And this is a pretty unique place to do this, because back to the point, there's very little bias or agenda here otherwise than sort of giving people a bit of a view, in layman's view, of what's going on each week and what we're seeing and what we're hearing. And we're privileged in our positions, Liam. We get to cover a lot of ground. I could pick up the phone and really speak to anyone. I'd like to see Minister Claire O'Neill in the studio to come and have a chat.
A little bit.
No, she's a good set of hands.
We're armed with the receipts, though. I don't think that might scare them.
I don't know. Come and have a chat with us. You're talking to a cohort of property investors, which was 2.8 million Australians invested in property or something like that. It's quite a few people.
It's a lot.
It's a lot of people. You want to keep them sweet. What I would say is that I went to a function, was it this week? Yeah, maybe really late last week, where, and again, sort of debriefing, I saw the Premier out at the, off the side of Anzac Bridge there, telling us that we're going to knock down those silos and they're transforming the power station there into housing and parklands and stuff. And I probably don't always agree with the politics of what's happening in New South Wales. However, what I would say is that I think he's a pretty good Premier.
Yeah, all credit to him.
Yeah.
I was it Bays West? I think it's a fantastic idea, and I don't necessarily think it's fair because a lot of you and I could be armchair critics, but the real armchair critics are guys that are fighting Facebook wars and everything in the comment section where they're like, oh, it's got with water views, they're going to be multi-million-dollar apartments, maybe.
Yeah.
But 8,500 new dwellings is needed. And if we're saying that land's just going to be not used at all, we're just not going to build on it.
Ideal spot.
It's a great spot.
Why wouldn't you be using it?
It's going to be on top of a new metro, so it's not going to have unnecessary... it's going to be obviously terrible for traffic, but the best location for it, if you're going to be building a metro there anyway, I can't think of a better location, proximity to the city. And when people attack it, it's like, well, what's the alternative? Do we want to send up... Do you want to send up more towers in Liverpool? Yeah, we can do that. Yeah. But I mean, what's the utility?
It's a great location. They're talking about knocking down those silos, which look okay at the moment because they're painted and they're good for advertising. But he's pretty much going, mate, these aren't heritage listed stuff. No. Knock them down. So I was at a function. I heard him speak, and it was part of the sort of tech council. And I was like, you know what, like. Those
thousands, it's not a number to balk at. It's actually quite good.
It's good to see bold, courageous, decisioning.
Yeah.
And anything to sort of support the supply side of things, I think should be encouraged. So, good work.
Yeah, I agree with that.
Good work, Premier, getting that sort of cracked. That's something I sort of clocked this week, which I thought was pretty good. So, hang on.
The Instagram handle, in case they don't respond, where can they contact you so that we can facilitate?
I think we probably need a new. What's the best way?
Well, you could just send it to me. Liam.Garman, Liam.Garman, not like the watch or the GPS, MAN at momentummedia.com.au, and I can consolidate anyone that wants to get in touch.
Yeah, brilliant, cool. All right. Nice one, gang. Well, thank you. Thanks for tuning in, everyone, for the weekly debrief. We'll get stuck into it. We'll keep an eye on what's happening, what we're hearing, what we're seeing, what we're going to, who we're talking to, views and opinions on what's taking place every week in and around property. You can see how expansive it is. We started off what's happening in the Middle East. And I tell you, it's a lot of people. Here's another thing. I saw... Gavin Rubenstein from Gavin Rubenstein Group.
Yes.
Talking about opening a Dubai office. I wonder if he's going to do that now.
Gosh.
There's been this big thrust and focus on Dubai around property and property investment. I've spoken to people who are sort of saying, you should be investing in Dubai and this, that, and the other. And this is connected with one of the questions earlier. And is a demographer called Bernard Salt, who you may have, and a lot of people would know about him. And he's always had this sort of concept, and I don't want to butcher this, so I apologize if I don't get this exactly right, but essentially the concept of, it's called the Dubai effect, right? Dubai effect. So the idea being in hostile areas with uncertainty and instability and political differences or religious differences, which is the Middle East. We've seen it play out right now. Because of that, there's still people making and creating quite a lot of wealth in those regions through a number of different means. They park their money in Dubai because it's seen to be a safe haven.
Yep.
So it's called the Dubai effect. So a lot of wealthy people in the Middle East create wealth, and then they park it in Dubai. And a lot of that is fueled through housing.
Yep.
And if you've been to Dubai, you would have seen it. And that's attracted a lot of people to it. Dubai housing has its own sort of heartbeat and rhythm. A lot of English, a lot of Australians are moving to Dubai for lifestyle reasons and all the reasons why, right? So this is really going to have seismic challenges to Dubai and the region. And from what I understand, they're actually all those foreigners who are inverted commas trapped in transit in Dubai. I think the government's picking up the tab for their hotel, right? Like, so they're going to do everything they possibly can to sustain this idea of Dubai being a safe haven in the Middle East, which is buoyed by the property and business community, right? This Dubai effect idea translates into Australia. So the idea, same concept, in the Asia Pacific, you have a lot of similarities in relation to disparate countries with geographic tensions and challenges. You only think about Taiwan and China. You only think about some of the regimes you have in some parts of Indo-China. There's a lot of instability in a lot of those countries. However, there's people who are manufacturing wealth. So the same thing applies. The Dubai effect, but what that means is they park their money in Sydney and Melbourne and Brisbane property or Australian property. So Australia being a safe haven for parking dough. And this goes back to the point about why our property markets are so different to maybe others when you have a view towards what the IMF or some of the other sort of international bodies think about. There's a lot of complicated constructual players in this market, which means it's very different. So this is one of the reasons why Australian property is very different, because of these Dubai effects. So our debriefs, we start in the Middle East and talk about these sort of things all the way down through to CGT and people diddling trust accounts, right? So very expansive. Back very, very expansive. But Liam, last word to you, sir.
Oh, I think that squares everything off.
Good.
Yeah.
Nice.
Thank you.
Very good. I've enjoyed this. I'm happy we've got the other blocks, our weekly debrief. We'll talk about anything, do Q&As. We'll make sure that we give people a lot of heads up. We just went live and obviously we've had a lot of people sort of go on it. So so you can watch this if you're tuning into it. Subsequent to the point, you can watch this across all the social channels. Jacob, moving forward, 9:30 on a Friday, unless I have a hangover from the night before because we've been at a function, which we typically have quite a lot of functions on a Thursday. Yeah. So I will preface that in advance. I might not be as animated as I always am. But a good bacon and egg roll and a coffee, I'm typically good to go.
Yeah. Boss Coffee for you. You're a
Boss Coffee. Proudly sponsored by Boss Coffee.
Yeah.
Send it through. Get a case. $4 a can.
Yeah. It's
cheaper than normal coffee.
It is actually, yeah.
Anyway. Cost of living crisis. Thanks for tuning in. This is the weekly debrief at SPI Live. I'm Phil Tarrant, my colleague Liam Garman. Great to spend an hour or so with you on a Friday morning. Have a great weekend and get stuck in. We'll see you again next week.